Right, Marco Palmero, founder of Ulysses in Dubai. In this video, I will share a very interesting story with you, how I lost a $3.5 million deal when I first started looking at acquisitions here in Dubai and in the Middle East. And I feel this is going to be very interesting because I'm going to share my journey, what I've learned from the transaction, and hopefully this will help anybody looking at acquisitions, looking at buying businesses, or just interested in the sector. And so I'm gonna give you a little bit of background around the deal, and then we will jump right into it and talk about 3 key mistakes that I made, in the execution of that particular deal. So to give you a little context, it was a time when I had recently moved to Dubai from the United States. Back in the day, I used to be in Miami and Sarasota. I was traveling between the 2 cities, and I had relocated to Dubai. And I had in mind this idea of consolidating assets, buying small businesses. And so I started the process with my partners that were based in Dubai, and we started looking at opportunities. We got some good deal flow, and back in the day it was very exciting because I used to go around a lot to build those relationships. I didn't have any kind of relationship at that time, and we ultimately ended up with a good pipeline of deals. We had around 5-7 deals that we were in discussions with at any point in time, and I ultimately picked one to be our first deal, so to speak. Now, this was a very interesting transaction. It was a small business, very simple to understand, and there wasn't a lot of complexity in it. And I had picked the deal for that specific reason. I didn't want my initial transactions, my initial opportunities to be complex. I wanted to be simple, pristine, very easy to execute on, and make sure I can get it done quickly and easily. Now, as we started the process of interactions with the owners, we asked, of course, a lot of questions around the transaction, around the business, around the reasons why the owner wanted to sell. But the first mistake that I made in that particular deal was that I didn't ascertain the motivation of the owner well enough. Now, what do I mean by that? Well, I simply asked the person what was the motivation for selling the business, but I didn't really explore and understood the truth behind that statement. What I've said in many other videos is that the first time you interact with a seller, at least from my experience, they're never going to tell you the real motivation for selling the business unless they're super desperate about this deal. And so you're always going to need to do some further investigation to really understand the psychological reason why this person wants to exit this particular investment. And so I didn't do that type of job because at that time probably I was a little bit impatient, and as a consequence I accepted the first reason as a good one or a good enough reason for me to proceed. And that was a critical mistake because I always repeat to myself that the most important thing you need to have in any transaction is a motivated seller. All the rest comes after. And so with that mistake, I substantially went against all my core principles of deal making and interactions with small business owners, which was, again, very bad for me, but it was one of my first times, and I probably underestimated the point of diving deeper into the psychological aspect of the deal and really making sure I understand the position of this other person. So this was the first mistake that I made early on in the deal. So subsequently to that, we decided to initiate the process of analyzing the deal. And as we went through the steps, 2 more mistakes came, which are kind of like intertwined. The first one was associated to due diligence. The other was associated to financing the deal. So we progressed with the transaction, and despite the fact I hired an external accounting and legal team to perform due diligence on our behalf, I think I didn't personally do enough investigation on the deal, and I ended up accepting some of the red flags, or let's call it amber flags, that were reported by our external firms as an acceptable thing in the deal. So I kind of like overlooked these problems, probably again because of impatience and because of emotion, because I felt that was our first deal and that I wanted to get it done badly. So, I didn't act logically and looked at the reporting in an accurate way. And so that mistake costed me a lot, because as we, progressed with the transaction, I realized that those mistakes, those problems couldn't be overlooked, and I needed to take action on that. And in some situation, and in this particular situation, it meant for me to kill the deal. And, consciously I realized it, but probably within me, I didn't want the deal to fail at that point in time, which again was a terrible mistake for my side, because I always believe that you should look at transactions very logically, but at that time I wasn't able to do that. So that was my second mistake. And in addition to that, again, tightly attached to it, there was the mistake of not dealing with financial institutions early enough in the process, not starting the interaction with financial institutions early enough. The point was, I greatly underestimated the time that was necessary for me to finance a deal in the UAE and Middle East. And I think that mistake was probably due to the fact that I had been in the US before, and I was accustomed to certain times for approval of loans and other business acquisition financing products. Problem was, I didn't realize that over there I might have had a relationship already. Plus, the US environment is generally quite friendly when it comes to financing and business acquisition financing. The UAE, we're in the same environment. And my mistake was that I thought everything would be the same. And so I started the process of building the relationship and discussing financing with banks too late. And as a consequence, we ended up being into a situation where we were getting closer to the final stages of the deal. But financing, was still very behind. I mean, banks didn't even start looking at the information memorandum. And so that was a huge, eye-opening experience for me, because I realized that banking sectors and financing in UAE operates on different timelines. And I needed to build this type of relationship earlier in the process, especially if I was starting from scratch. That, again, very terrible mistake from my side. But thankfully, I only made it one time. Then I could adjust and really fix that problem immediately in the subsequent transactions that we looked at. So to put it simply, we ended up into a situation where, it was kind of funny, because you might be saying now, well, you messed up everything you can mess up about a deal. And, it is true. In that particular case, I let emotion take control, and that made me overlook stuff. Two of the major things I overlooked, some amber flags and the motivation of the seller. In addition to that, I didn't time the deal right, and then I didn't have financing available to structure the acquisition. So ultimately, as you can imagine, that deal didn't go through. And I think from my perspective, it is interesting to analyze all the mistakes that I made, because it is funny to see how one mistake leads to more mistakes later down the line. Because as I always say, and I always preach, so to speak, if you don't have a motivated seller, you shouldn't really pursue a deal. That's what I believe in personally. And so the first mistake I made, which was not understanding the motivation well enough, led me to make other mistakes in the deal, which was a transaction that I should have never looked at in the first place, because one, I didn't have a motivated seller. It was just a clear next. But my emotional side led me to overlook that thing. And guess what? I continued making mistakes, and the deal, kept getting worse over time. And so it was funny to me because I really realized that compromises really don't exist in business acquisition. It's a very logical process, straightforward process. If something doesn't match with goals and aspirations in criteria that I have, there's no flexibility really. And so it should always be a clear tick in the box. If we don't have that, I don't want to proceed. Because see, if you have some sort of wiggle room and you have some allowances earlier in the process, you're going to be very willy-nilly about the entire deal. And that can lead to other potential mistakes later down the line. But if you just make one mistake, that's one thing. But if you make multiple, the deal is going to completely get off track. And this is obviously something I always want to avoid. And so my point is, in the main lesson I've learned is that it's always important to always control the deal at any point in time and always get what you need out of each step, because that will prevent you from compounding the mistakes and then ending up in a completely messed up situation. So again, to summarize, my 3 mistakes that made me lose this $3.5 million deal were not understanding the motivation clearly, then the due diligence side, I overlooked some amber flags, and then the financing part. I didn't time the deal well enough for me to execute. So hopefully this video was helpful for you. Of course,